OR, an oil retail giant, is standing at its inflection point. Once a cash cow, its oil business is being shipped away by competitors, and its growth engines are starting to lose their power. Good morning, ladies and gentlemen. We would like to initiate a sell recommendation with a target price of 12.1 baht, indicating a 15.4% downside. OR is the largest oil retailer in Thailand, with over 2,000 BT stations coverage, relying on its massive footfall of 3.9 million visitors per day to cross-sell its high-margin lifestyle business with Cafe Maison as a flagship. Since its IPO, OR continues to expand, and further expand. First, expand their branches using an asset-light model. Second, expand their ecosystem by investments in new businesses. And third, expand internationally with a global segment. Now, if you look at the financials, despite contributing only 3.7% of total revenue, the lifestyle segment actually drives around 1/3 of total EBITDA.
So once we know more about OR, let's take a step back and look at the big picture. The oil demand in Thailand is projected to grow at 1.3% CAGR to 2030, but the growth is limited by EV disruption threats. With the context and the backdrop of limited market growth, the competition is growing. Oil marketers in Thailand is dominated by three main players: OR, BCP, and PTG. All of these combined selling over 85.7% of total retail volume sold in Thailand. However, OR has been bleeding its share to competitors over the year due to the growth of PTG and the consolidation of BCP.
Let's move on to the brighter side. The cafe market grew at an 8% CAGR in the past 5 years. To understand where Cafe Maison competes, cafe can be segmented by price into four, with Cafe Maison operating in the mass segment. In this segment, customer decision based on store availability, price and promotion, and brand familiarity. Together, position this segment as value to money oriented.
So once we know all of these contexts and all of these dynamics, the key question is, how are this going to affect OR performance? We expect OR performance to be weakened due to our three S's. First, stagnant mobility business. Second, saturated lifestyle business. And third, slow scaling in new businesses. So let's start with our first S, stagnant mobility business. It will weaken OR cash cow status due to limited market share gain upside and rising EV risk. First, on market share. OR's management has target 1 to 2% retail market share gain with three main initiatives: increase station coverage, improve non-oil and service offerings, and lastly, introduce more promotions. However, we believe that the upside from these strategies is limited as OR has no strategic lever left to pull. First, on location. Further expansion could cannibalize existing store as seen by persistent dropping volume per station. Second, for non-oil. These used to be a plus and differentiator for OR. However, it is just a must as competitors are now catching up. Lastly, on pricing. Discount has been introduced in 2025. However, but still, it results in very limited market share movement. Furthermore, OR is the most exposed to rising EV adoption risk due to its high reliance on gasoline sales compared to its peer. While EV Station Plus has been expanded to capture that demand growth, still, we don't believe it's going to offset oil EBITDA loss due to the current low utilization rate, and it's even harder pathway to ramp up utilization due to at-home charging preference.
With stagnant oil business growth, investors are shifting their focus to lifestyle business as a growth engine. But we believe such growth is reaching saturation. We anticipate Cafe Maison revenue to grow at 3.7% CAGR through 2030 across three main levers. First, store expansion is expected to slow down. In the past, Cafe Maison revenue growth has been driven by store expansion, but now network coverage is approaching saturation, as evidenced by underperforming openings. As a result, to maintain its growth, Cafe Maison further required to focus on increasing its revenue per store, which leads to our second and third levers. Second, console per store would decline as competitors open and expand in Cafe Maison proximity, especially Kantar, its main competitor, which has an ambitious goal to attain 5,000 stores by 2028, reaching the same level of store as Cafe Maison. Third, per cup growth is expected to slow down. With limited pricing power in the mass segment, cafe restaurants can only rely on premium selected cups and non-drink segment to lift their revenue per cup. But their overall contribution is still to be proven.
Okay, now given the weak outlook in the mobility and lifestyle segments, let's move on to our last S, slow scaling in new businesses. OR is seeking new growth through overseas expansion and investments. However, both of these initiatives face structural headwinds. Let's start with the global segment. Revenue is expected to decline and recover, but margins remain pressured due to the shifting product mix towards white retail. Let's look deeper into each country. In Cambodia, Cafe Maison's presence is the highest, but due to the border conflict, we expect an exit. In the Philippines, while growth is attractive, OR's oil market presence is still low. In Laos, OR's oil volume sold contribution and Cafe Maison's growth is limited. Next, let's look at investments. OR's return on investment has never exceeded its return from cooperation. If we look forward, equity income has limited growth as it relies heavily on pipeline assets, while the lifestyle exposure is concentrated in Ottery, which operates in a red ocean laundromat market.
With OR3 segment, mobility is structurally challenged, lifestyle is mature, and with new businesses remain pressure. But with the low current trading price, our key question is the price right? Our conclusion is no, and I'll highlight the key drivers underpinning our valuation view. Let me start off with how our three SDs, standard mobility, saturated lifestyle, and slow scaling in new businesses are reflected in the forecast. The three SDs are reflected in the operational assumption of our valuation model that are directly driven and have the result of 1.9% domestic oil volume CAGR, 2.2% capital CAGR, 1% global oil volume CAGR. This is the result of slower gas station expansion, cafe maison level maturity, and limited contribution from new businesses. We also expect the marketing margin to stabilize at about 0.96 Thai baht per liter, in line with historical and management target. And after we put all this together, we came to a group revenue CAGR of 1.6% from 2025 to 2030, in declining from historical rate. And we also got an EBITDA margin that has been limited in expansion during the forecast period. After we got this operating profile in mind, now we move on to examine further on how this impact the cash flow. So, even though the OR lower growth is having experienced lower growth at this moment, this company still requires sustained reinvestment. The CapEx plan from 2025, expected CapEx plan from 2025 to 2030, although on a decline on a moderate trend due to growth CapEx on the decline side from slow gas station expansion and slower cafe maison expansion. But however, the maintenance CapEx remains structurally stable due to ongoing asset replacement. And now, after we put all this together, we move on to our FCF DCF valuation, where we got a target price of 12.1 Thai baht, representing a 15.4% downside, affirming our sale recommendation. This is based on a weighted average cost of capital of 9.25% and terminal growth rate of 0%, reflecting an maturing oil retail industry.
We are confident in our sale call and have identified 5 potential risks that could change our recommendation, but only 2 are prioritized. First, if marketing margin will increase to 1.1 GP per liter, it would result in 12.2% upside. Second, if cups over store of Cafe Maison grow to 1% and EBITDA margin maintained at its all-time high of 34% EBITDA margin, it will result in 6.3% upside. Furthermore, we also conduct ESG analysis. OR helped generate income to over 16,000 communities as well as efficiency 1.4 billion baht of profit from the local farmer in the recent years. However, environmental progress remains challenging. Carbon emission continue to increase relative to its revenue, leaving its performance behind peers. As well as on the governance side, with PTT holding over 75% of voting control, this creates a risk to the minority shareholder on the key strategic decision. With all this together, we come up with our summarize. We issue our sales recommendation with a target price of 15 point.
What is your assumption that different from the market assumption, the consensus? What number that you are differentiate from the market? That creates the opportunity you are talking about.
So for our assumptions, can you go to the assumption summary sheets? So I think our key assumption that is different from the market is our view on cafe and maison. While some of the market and street participants anticipate that the strategies to revamp our retail market is going to be effective due to pricing promotion and further management focus, I think that's going to be one of our key difference. We believe that the retail market share gain would have limited results. Another key assumptions that we are different from other analysts and others and that market is that we are more bearish on cafe and maison with two key drivers. First is the cafe and maison, while it's growing and has strong brand, the competitors are now catching up and the competition in this market is fierce. And second is that as cafe and maison, as we have presented before, cafe and maison has driven its growth by expansion. However, at this scale, it is much harder for Amazon to scale further and expand further.
And why is the revenue per store for Amazon still growing?
Cafe Maison revenue is there are three drivers as we have said. The first one is store expansion, which we still expect it to grow, but at a slower rate because recently they have been lowering their expansion and we.
I mean the revenue per store.
Sorry.
Your assumption is the decline in the volume cup per store, right? But the revenue per store you seem to be going up.
Oh, sorry. Just to clarify, can you go back to the assumption summary sheets? Okay, so you refer to this line, right? This is for the global segment.
No, the middle one. Also, that's for.
That's for 7-Eleven?
That's for 7-Eleven and convenience stores. Sorry for the confusions.
Okay. So, what is your forecast for the EBITDA margin over the next 5 years? If we see the decline in the cup per store, we should see the decline in the margin as well, right?
Yes, for sure. For lifestyle business segment, more specifically in the F&B segment, which mainly composed of cafe and maison, we expect that in the first year, year 2026 forecast, we expect that the margin would drop a little from 2025, which is peak year for cafe and maison due to the cut in the Texas exit in 2024, which improved the margin by 2%, and in 2025, OI has implemented not outsourcing some of the material, which caused an increase in 3% EBITDA margin. However, we believe in the later years, this margin would gradually decline since we expect more competition from the competitors, especially Thai, and also we believe that Cafe Amazon would spend more on member privilege, which would also further dilute its EBITDA margin.
Can you go back to your valuation? So what methodology did you use for evaluating OR? Yeah, that's right.
So mainly we use the DCF valuation on our model, and we also cross-check it with the multiple relative valuation as well as forward PE and EBITDA.
So why don't you use EV per EBITDA?
So one thing that we have taken into consideration is could you open the peers. Before we look into the peers of OR right now, and the peers, we have selection of criteria of the IPO periods, and we have selection that there may be some mismatch between OR and the periods. That's why I don't think that the periods like the median and the multiple valuation would really affect and will really take into effect the what we expect of Cafe Amazon. And the other point is that in Asia valuation, we have a different assumption more than market expected. We expect Cafe Amazon will be perform more pessimistically compared to the market. That's why we use the Asia valuation.
Thank you.
One of the questions or one of the things you stressed on a regular basis was margin pressure or margin compression. I would be interested as a potential investor. Some companies very much explore AI adoption as a means also to improve margins. You saw it especially in the tech space, which resulted unfortunately in layoffs. Did you sufficiently consider also the question of AI adoption for such a company such as OR and to improve margins?
Okay, so to answer that question, we will break down into two parts, which is AI integration in SG&A and AI integration in terms of cost of goods sold reduction. We believe that in terms of cost of goods sold, in terms of expense by nature, OR operates on very commodity-like nature, which is to buy oil and to buy coffee, sorry. And we believe that there is very limited margin expansion opportunities by AI adoption. However, in terms of SG&A, we believe that there is some incremental help, but we don't think that there's going to be material because the AI implementation that OR can use can be in terms of more strategic. For example, they have implemented AI tools for station and geographic for new station and branch coverage to consider competitors and to consider other factors before new branches and stations opening. We, however, believe that it cannot materialize into margin expansions, and we cannot lay off those employees and overhead workers. Sorry.
Earlier I heard you mentioned Pan Thai is catching up with Amazon. I still don't can you justify that because PTT has the highest amount of branch in Thailand as Amazon is in every branch. So how can PT suddenly have enough branch to cover to the same level of PTT and then have the same amount of Pan Thai branch?
So to clarify the question, you mean how did Pan Thai suddenly gather the power to expand their store to catch up with Cafe?
Yeah, because like Protocol has a lot more gas station than PT, right? And in every branch there is Amazon. So how can suddenly you expect that like Pan Thai will suddenly have enough branch in the same level as Protocol at certain point?
Okay, so let me handle that question. Can you go to the levers page on the main deck? So first of all, as we can see, OR, as you has already mentioned, OR and PTT has already covered all the Cafe Amazon in the gas station. However, PTT still has white space in terms of its gas station. Therefore, we see that there is an opportunity to further expand in the gas station and petrol station. However, the key strategic difference is that Pan Thai focusing more on outside of gas station and targeting mass segments in opening in universities or in the office buildings. Therefore, we believe that Pan Thai has more space to play and without constraining itself by only gas station.
I thought I saw Amazon outside in this building.
Yes, in terms of breakdown, I think it's kind of fairly, in terms of breakdown, Pan Thai has more station outside of petrol station, while OR has around 50% breakdown. Therefore, I would say that Pan Thai has more strategic intent to expand further.
You raised the risk about corporate bonus at PTT or is the major shareholder. Do the company did anything that is bad for the minority shareholder in the past?
So actually we see this risk as a key challenge to the minority shareholders. However, we consider this risk as a limited because of we consider that when investors want to invest in this stock and they already see all the shareholder who are the main shareholder. So that's bring us to the low risk on the governance.
Okay, just to add on to my colleague, So OR is a subsidiary of PTT. So and in order to maximize the majority shareholder, the board has to vote in favor of PTT. So minority interest has limited voting power.